Hello and welcome to our channel. If you are a returning viewer, welcome back. And if you're new here, please give us a like and show us support by subscribing to our channel. Thank you so much. Now, without further ado, let's get into the video. No modern-day investment sage is better known than Peter Lynch. Not only has his investment approach successfully passed the real-world performance test, but he strongly believes that individual investors have a distinct advantage over Wall Street and large money managers when using his approach. Individual investors, he feels, have more flexibility in following this basic approach because they are unencumbered by bureaucratic rules and short-term performance concerns. Mr. Lynch developed his investment philosophy at Fidelity Management and Research and gained his considerable fame managing Fidelity Magellan Fund. The fund was among the highest-ranking stock funds throughout Mr. Lynch's tenure, which began in 1977 at the fund's launching and ended in 1990 when Mr. Lynch retired. Peter Lynch's approach is strictly bottom-up, with selection from among companies with which the investor is familiar, and then through fundamental analysis that emphasizes a thorough understanding of the company, its prospects, its competitive environment, and whether the stock can be purchased at a reasonable price. His basic strategy is detailed in his best-selling book, One Up on Wall Street, which provides individual investors with numerous guidelines for adapting and implementing his approach. His most recent book, Beating the Street, amplifies the theme of his book, providing examples of his approach to specific companies and industries in which he has invested. Lynch is a story investor. That is, each stock selection is based on a well-grounded expectation concerning the firm's growth prospects. The expectations are derived from the company's story, what it is that company is going to do, or what is that is going to happen to bring about the desired results. The more familiar you are with the company and the better you understand its business and competitive environment, the better your chances of finding a good story that will actually come true. For this reason, Lynch is a strong advocate of investing in companies with which one is familiar or whose products or services are relatively easy to understand. Thus, Lynch says he would rather invest in pantyhose rather than communication satellites and motel chains rather than fiber optics. Lynch doesn't believe in restricting investments to any one type of stock. His story approach, in fact, suggests the opposite, with investments in firms with various reasons for favorable expectations. In general, however, he tends to favor small, moderately fast-growing companies that can be bought at a reasonable price. Selection process. Lynch's bottom-up approach means that prospective stocks must be picked one by one and then thoroughly investigated. There is no formula or screen that will produce a list of prospective good stories. Instead, Lynch suggests that investors keep alert for possibilities based on their own experiences, for instance, within their own business or trade, or as consumers of products. The next step is to familiarize yourself thoroughly with the company so that you can form reasonable expectations concerning the future. However, Lynch doesn't believe that investors can predict actual growth rates, and he is skeptical of analysts' earning estimates. Instead, he suggests that you examine the company's plans. How does it intend to increase its earnings, and how are those intentions actually being fulfilled? Lynch points out 5 ways in which a company can increase earnings. It can reduce costs, raise prices, expand into new markets, sell more in old markets, or revitalize, close, or sell a losing operation. The company's plan to increase earnings and its ability to fulfill that plan are its story. And the more familiar you are with the firm or industry, the better edge you have in evaluating the company's plan, abilities, and any potential pitfalls. Categorizing a company, according to Lynch, can help you develop the storyline and thus come up with reasonable expectations. He suggests first categorizing a company by size. Large companies cannot be expected to grow as quickly as smaller companies. So here are some of the key numbers Lynch suggests investors examine. Year-by-year earnings. The historical record of earnings should be examined for stability and consistency. Stock prices cannot deviate long from the level of earnings, so the pattern of earnings growth will help reveal the stability and strength of the company. Ideally, earnings should move up consistently. Earnings growth. The growth rate of earnings should fit with the firm's story. Fast growers should have higher growth rates than slow growers. Extremely high levels of earnings growth rates are not sustainable, but continued high growth may be factored into the price. A high level of growth for a company and industry will attract a great deal of attention from both investors who bid up the stock and competitors who provide a more difficult business environment. The price-earnings ratio. The earnings potential of a company is a primary determination of company value, but at times, the market may get ahead of itself and overprice a stock. The price-earnings ratio helps you keep your perspective by comparing the current price to most recently reported earnings. Stocks with good prospects should sell with a higher price-earnings ratio than stocks with poor prospects. The price-earnings ratio relative to its historical average. Studying the pattern of price-earnings ratio over a period of several years should reveal a level that is normal for the company. This should help you avoid buying into a stock if the price gets ahead of the earnings or sends an early warning that it may be time to take some profits in a stock you own. The price-earnings ratio relative to the industry average. Comparing a company's price-earnings ratio to the industry's may help reveal if the company is a bargain. At a minimum, it leads to question as to why the company is priced differently. Is it a poor performer in the industry, or is it just neglected? The price-earnings ratio relative to its earning growth rate. Companies with better prospects should sell with higher price-earnings ratio, but the ratio between the two can reveal bargains or over-evaluations. A price-earnings ratio of half the level of historical earnings growth is considered attractive, while relative ratios above 2.0 are unattractive. For dividend-paying stocks, Lynch refines this measure by adding the dividend yield to the earnings growth. In other words, the price-earnings ratio divided by the sum of the earnings growth rate and dividend yield. With this modified technique, ratios above 1.0 are considered poor, while ratios below 0.5 are considered attractive. That was today's video. Thank you so much for watching, and I hope you enjoyed it and that you learned something interesting. Comment down below what you liked the most about this video and suggest any topics that you would like to hear about in future videos. To show us support, please give us a like and subscribe to our channel, and I will see you in the next video.